Hello, I can't hear you. Mr. Ashwaju.
Sir, if you can hear us, your network is bad.
This online class.
All right.
Uncertainty.
Please, can you mute your speaker? It was a network glitch. Occasionally, we might experience it. Now, let's go to this topic. I'm trying to create an overview of this topic. If a company is experiencing financial crisis, financial difficulties, what are the measures company can take to prevent the company from eventual collapse? This is the topic we are discussing tonight. Corporate reorganization and capital reconstruction. We understand the fact that companies are established for a particular purpose. We understand that fact. Organizations are established for a particular purpose. For example, Zenith Bank is established to provide banking services. From these banking services, the bank generates profit for the owners of Zenith Bank. The bank is established to provide banking services. From these services, the bank generates profit for the owners of the bank. Dangote. If you take Dangote Cement, Dangote Cement is established for a specific objective. The company is to manufacture and sell cement. From this manufacturing and sales, the company generates income for the owners of the business. Now we now have corporate failure. When a company cannot achieve its objective, when a company cannot achieve the objective for its establishment, then we said the company is experiencing corporate failure. When a company cannot achieve the objective for its establishment, a company is established to make profits. Dangote is established to make profits. Zenith Bank, GT Banks, they are established to make profits. We now say corporate failure. A situation where a company cannot achieve profit consistently is called corporate failure. a situation where a company established for profit-making purposes cannot consistently achieve profits, then we said the company is experiencing corporate failure. In that case, that company is experiencing financial difficulties. A company established to make profits, and that company cannot make profits over a long time. You can make profit in year 1. You can make profit in year 2. You can make profit in year 3. The company is experiencing financial crisis for a number of years. In that case, we said that company is experiencing a symptom of corporate failure. Now the question is, when a company is experiencing financial crisis, when a company is experiencing financial difficulties, management must decide. Management must take necessary actions. The management of the company must take necessary actions to prevent the business from collapsing. It is the responsibility of the company's directors to take necessary actions to prevent the business from collapsing financially. There are several measures. There are several measures company can take. There are different actions company can take. One of these actions is called capital reconstruction. One of the measures that could be taken is called capital reconstruction. So, what is capital reconstruction? You can also call it financial reconstruction. What is capital reconstruction? Capital reconstruction is a major reorganization of the capital structure of a company. Capital reconstruction is a major reorganization of the company's capital structure. Capital reconstruction is usually done. Capital reconstruction is usually carried out when a company is experiencing financial difficulties. Capital reconstruction is usually carried out when a business is experiencing financial difficulties. Capital reconstruction is carried out with an objective to prevent the company from eventual collapse. A capital reconstruction might involve revaluation of assets, raising new capital for the business. Capital reconstruction might involve asset revaluation, raising additional capital to the business, conversion of debt capital into equity capital. You are converting debt capital into equity capital. 4, conversion of equity shares from one form of equity to another form of equity. 5, existing shareholders might be required to relinquish all their shares and accept a smaller quantity of new shares in the reconstructed companies. Existing shareholders might be required to relinquish, that is, give up all their existing shares and accept a smaller quantity of new shares in the reconstructed company. The purpose of capital reconstruction, the objective of capital reconstruction is to find a way of allowing the company to continue in business. Remember, the company is in financial crisis. You now carried out a capital reconstruction. The objective, excuse me, please. The objective of your capital reconstruction is to find a way of allowing the company to continue in business and avoid insolvency or liquidation. You are trying to prevent the company from liquidating. Please, 1 minute. Let's continue. I'm trying to take water. So we said the purpose of capital reconstruction is to find a way of allowing the company to continue in business and avoid insolvency, that is liquidation. Yeah, good night. A capital reconstruction. A reconstruction is only worth considering. You are only going to consider capital reconstruction if that capital reconstruction is likely to be more beneficial if that capital reconstruction is more beneficial to all the parties involved than the liquidation of the company. We are going to recommend capital reconstruction if that capital reconstruction provides more benefits to the stakeholders than liquidating the company. And also, we are going to consider capital reconstruction if the reconstructed company, that reconstructed company has a good chance of surviving and restoring itself to profitability. We all know the case of Diamond Bank. Diamond Bank, established in 1988 or 89. The bank was established to generate profits. After many years, the bank ran into financial crisis. And all of a sudden, the bank was reporting losses. The owners tried. Eventually, the bank was liquidated. The bank was taken over by another bank under acquisition. You can see, as finance professionals, we must understand when a company is having financial crisis. Accountants, our training, we have been given the skills to understand the symptoms of corporate failure, the signs that a company is experiencing financial crisis. If you notice these symptoms, it is your responsibility to alert management. We need to take action urgently, otherwise this business might collapse. A reconstruction will provide benefits to all the parties if that reconstruction will give us more cash or more value. If the stakeholders will get more cash from the reconstruction or more value from the reconstruction, then we are going to recommend capital reconstruction. All right. We have explained corporate failure. We explained capital reconstruction. We explained the purpose of capital reconstruction. What are the likely consequences of capital reconstruction? What are the likely consequences if you suggest capital reconstruction to a business because the business is having financial crisis, what are the possible consequences of capital reconstruction? One, there is likely to be reduction in total debt, reduce total debt of the company. If you propose capital reconstruction, the level of debt is likely to reduce. This is because some debt capital might be converted to equity capital. Debt liability is likely to reduce. Look at the logic. If a company's debt liability reduces, the interest payments will also reduce. The interest expense will reduce. By converting equity, by converting debt capital into equity capital, your liability will reduce as a company. Your expense will reduce as a company. Number two consequence, defer the repayment obligations of other debts. Meaning that we are likely to defer repayment obligations of other debts. You are trying to push forward. You are trying to defer repayment of outstanding liability. As a result of capital reconstruction, we try to reduce the debt burden for the business because the business is already experiencing financial difficulties. And we don't want that business to collapse. We don't want that business to collapse. Number three consequence, majority of the new shares in the reconstructed company might be held by banks or bond holders. Majority of the shares on the reconstructed company might be held by banks and bond holders who agree to exchange their loan or bond for new shares. Look at the logic. By converting debt to equity, the debt holder now becomes shareholders in the company. The debt holders are likely to now become majority shareholders in the company. The debt holders are doing the company a favor. Debt holders are giving loan to the company. The company cannot pay back the loan as a result of financial crisis. To prevent the company from collapsing, from liquidation, debt holders agree to convert the debt to equity. They are now part of the shareholders in the company. The reduction in total debt and deferral of interest payments and principal repayments by reducing your total debt, by deferring interest payments to future periods. This might allow the company to make profits and achieve positive cash flows. Remember, the objective of capital reconstruction is to find a way to allow the company to continue in business, to allow the troubled company to continue in business and avoid insolvency. All right. However, there could be problems with capital reconstruction. There are two major problems. One is finding capital reconstruction arrangements that will benefit all the parties, all the stakeholders. Who are the stakeholders? Who are the stakeholders to a business? The ordinary shareholders. They are stakeholders. The debt holders. They are stakeholders to the business. The trade creditors who supply goods on credit. Banks who provide lending. When a company is experiencing financial crisis, all the stakeholders will be alerted. Debt holders has provided loan to support the business. Now the business is experiencing financial crisis, financial difficulties. The company cannot pay back the interest elements and the principal repayments. Lenders must be alerted. Banks provide overdraft and other funds to support a business. When that business is having financial crisis, bank must be notified. Shareholders, they are also stakeholders. So, one major problem is finding a reconstruction arrangement that will benefit all the parties involved. The second problem is getting all the parties to agree to the reconstruction. Getting the parties to agree to the reconstruction scheme. Some stakeholders may disagree that please, let us liquidate the business. Let us sell the assets. Give me my money back. All right. We compare what they will receive if the reconstruction scheme is agreed. And if the reconstruction is rejected and company liquidated, for this topic, you are going to become. If the company is liquidated, what do I stand to benefit as a stakeholder? Alternatively, if the company is reconstructed, what do I stand to benefit as a stakeholder? You now compare. All right. Principles of capital reconstruction. Principles of capital reconstruction. There are three fundamental principles. There are three fundamental principles of capital reconstruction. What are these principles? One, principle one. Look at it here. No creditors must be made worse off. Creditors must not no creditor must be worse off under reconstruction than they will be under liquidation. Liquidation is also called receivership. That is principle number one. Creditors must not be made worse off under capital reconstruction scheme than they will be because the agreement of creditors is required for a capital reconstruction to take place. If they are worse off, they will not agree. What does worse off mean? Let me try to put an illustration to it. Let me try to put an illustration to this. Okay, Abigail. Assuming you gave a loan to a company. You loan a company 100 million naira. And the company is to pay you back in five years. The company will pay you interest annually and the principal repayment in 5 years. A year later, that company ran into financial crisis and they can't pay back your money. In the book of the company, you are a creditor. You have provided loan. The company is now considering capital reconstruction. That look, we want to convert your 100 million naira loan to equity. We are going to convert it to equity. They now say, okay, this 100 million naira loan will be converted to equity that worth 70 million naira under reconstruction. We are going to give you equity shares that are worth 70 million naira. That is under reconstruction. Now, before you can accept that, remember it's a proposal to you. Before you can accept that proposal, you are going to ask yourself, if this company is liquidated and the assets sold, how much can I get? Assuming if the asset is disposed, you can get 80 million. If the company is liquidated, if the company is reconstructed, you can get 70 million. That means under reconstruction, you are worse off. It is better for you to accept towards liquidation. Reconstruction offer you 70 million. Liquidation offer you 80 million. In that case, a creditor has been made worse off under reconstruction scheme than they will be under receivership. Obviously, Abigail, you are not going to agree to that reconstruction. If the company is liquidated, I will get 80 million. If the company is reconstructed, I will get 70 million. Definitely, I will not agree to reconstruction. Because that reconstruction has made me worse off. Is that better, Abigail? Principle 2. Post-reconstruction profitability. Please, just 1 minute. I got to take water. All right, thank you, guys. Principle 2. Post-reconstruction profitability. This means that there must be a good chance that the company will be financially viable and profitable after reconstruction. Remember, the company is in financial crisis. The company is in financial difficulties. We now try to reconstruct the company. There must be an assurance that if this company is reconstructed, the company can return to profitability. The company will be financially viable. It does not make sense to go through the trouble of reconstruction. After you have reconstructed the company, you have done all the trouble. A month later, the company now collapsed. So it's like saying, if you are going to repair an old car, then you must have assurance that if I repair this car will work. If I should spend money on this old car, this car will function. Principle 3. It must be able to be demonstrated that reconstruction scheme is fair to all parties involved. The reconstruction scheme should be fair. The concept of fairness that reconstruction scheme should be fair to all parties concerned. The principle of fairness or the concept of fairness is important in assessing the suitability or acceptability of any proposed reconstruction scheme. All right. We are back. All right, I was trying to say that we shall be guided by this principle when evaluating capital reconstruction scheme. All right. Evaluating capital reconstruction scheme or analyzing capital reconstruction scheme. What are the steps that should be followed? Paul, you can mute your video. You can close your video. What are the steps that should be followed if you are to evaluate a capital reconstruction scheme? Number one step is that you must understand the principle of capital reconstruction. We shall be guided by the three fundamental principles of capital reconstruction. Number two, step two, we are going to consider situation in liquidation. That is, we are going to assume that if this company is to be liquidated, assuming we are to liquidate this company, who gets worse? We are going to make an assumption that, yeah, this company is financially troubled. This company is in financial crisis. The company is in financial difficulties. Let us assume we are to liquidate this company. How much can we realize from the sale of the company's assets? Then, who gets worse? How are we going to distribute the money realized from the liquidated assets? Look at that statement. A company is in financial crisis. The company has not collapsed, but we know the company is facing financial problem. We now assume that if this company is liquidated and we are to sell all the company's assets, how much can we realize? Then, how are we going to distribute the realization? Who gets what? Now, please note, guys, in the event of a company being liquidated, in the event of a company being liquidated, the proceeds of the liquidated assets shall be distributed as specified by Bankruptcy Acts. The proceeds of the liquidated assets shall be distributed according to the law. The law is the Bankruptcy Act. What we are trying to say is, when a company is liquidated, you cannot use your idea or your initiative to share the money. Law specify how the money should be distributed. Who is going to collect first? Who will collect second? The law specify priority of distribution. What is the priority? Look at the screen, please. The priority of payments in the event of liquidation. Who will collect first? Number one, fees charge, secure creditors. Number one, that will collect money. The first person that will collect money is called fees charge, secure creditors. So the question will be, who are the fees charge, secure creditors? What is fees charge, secure creditors? We are going to explain this and also illustrate this. Okay. Yes, I adjusted it deliberately. And one that changed it deliberately because it creates confusion for students. So we are going to take this arrangement. Who is fees charge? Or what is fees charge? When a liability is secured on a particular asset of a business, when a liability is secured on a particular asset of the business, that is called fees charge. Let us illustrate this. All right. Assuming we have a company, XYZ, a company assuming we have a company XYZ PLC. This company has properties. Properties located in Victoria Island, one property in Victoria Island, another in Ikeja, another in Abuja. Let's talk these three. XYZ PSC has property located in Victoria Island, Ikeja, and Abuja. Now the company approached a bank. The company approached GT Bank to obtain a loan of 100 million. Loan for GT Bank. A loan of 100 million. And XYZ decided to use his property in Abuja. This loan is secured on property located in Abuja. The loan is secured here. The liability is secured on a particular asset. The asset located, the property located in Abuja. Where liability please, can you confirm you can hear me?
Confirmed. We can hear you, sir.
I can hear you.
All right, so the network is becoming erratic now. All right, let me explain this again. The loan, that loan is a liability secured on property located at Abuja. That is fixed charge. Where a liability is secured on a particular asset of the business, that is called fixed charge. Now, in the event of liquidation, if XYZ is liquidated, if this company is liquidated, any money realized from Abuja property must be given to GT Bank first. Before anybody can collect money, any money from this asset cannot go to any person other than GT Bank until 100 million is complete. Now, assuming this property at Abuja is liquidated and sold, we now realize 80 million here. The proceeds realized here is 80 million. This 80 million will be used to repay GT Bank loan. The loan is 100 million. Abuja property get a proceed of 80 million. The balance of 20 million outstanding. Now, please note, GT Bank lender, GT Bank cannot go to any other property again. GT Bank will not have rights to go to any other asset of the company. They don't have rights to move to another asset for the purpose of claiming 20,000 balance. GT cannot move to another asset. This balance will be claimed. This balance, GT Bank will claim this balance, 20 million, as unsecured creditors. This balance, GT Bank will now go and join other unsecured creditors for the purpose of claiming balance of 20 million. That is fixed charge. Fixed charge secure creditors. Now, the question will be, assuming the property realized 150 million, assuming this property we realize 150, we are going to give 100 million fully to repay GT Bank loan. The balance will be transferred back to the company to settle other liabilities. So any question for me? That is fixed charge. Any property used as fixed charge cannot be given to any other person until that liability is settled. Then next, preferential creditors. Who are the preferential creditors? They include unpaid wages, unpaid pensions, unpaid taxes. You know, if a company is having financial crisis, it is very possible that company will not pay staff salary again. That company may reduce staff salary, or may not even pay salary at all. The company may fail to remit taxes. In that case, if law says if that company is liquidated, the money you get from that asset, go and settle preferential creditors. But you cannot use fees charge. Any assets for fees charge is already fees to a liability. You now go to other assets to settle preferential creditors. Then number 3, floating charge secure creditors. This is opposite of fees charge. Floating charge secure creditors is opposite of fees charge. Under floating charge, liability is secured on all the assets of the company. Under floating charge, a liability is secured on all the assets of the company, not a particular asset. In the event of liquidation, all the assets shall be used until the loan is repaid. All right, let's continue. I observed that once it's getting to like to 10, that appears the network strength becomes low. All right, we are trying to explain redundancy payments. Payment to employees for making them redundant as a result of the company being liquidated. Obviously, if a company is liquidated, assets sold, employees will go to their various homes. They go look for another job. For making them redundant, company may make payments for that purpose. In that case, we are going to settle that. Then number 5, unsecured creditors. Who are the unsecured creditors? Like trade payables. At times, bank overdraft unsecured. That is liability without security. Then number 6, preference shareholders. Then lastly is the ordinary shareholder. When a company is liquidated, the ordinary shareholder will collect money last. Please, you are going to note this order, or you might memorize it. This topic we are doing can reflect in your case study. Now, all this will happen in step 2. In your step 2, you are going to assume that if the company is liquidated, now your step 3. You are going to check the cash position of the reconstruction scheme, cash adequacy. What does this mean? You are going to check how much finance do you require to implement the capital reconstruction scheme? How much finance do we require to implement the capital reconstruction scheme? Then check, what is the finance available? The finance available must be sufficient to implement your capital reconstruction scheme. So you are going to check that. We call it finance adequacy or cash adequacy. Step 4, text the post-reconstruction financial viability. You are going to text, meaning that you are going to evaluate if this company is reconstructed, what is the statement of profit or loss after the reconstruction? Can we achieve profits? So you are going to text for post-reconstruction financial viability. You are trying to evaluate the financial future of the business or the future financial viability of the business. You can calculate post-reconstruction earnings per share. After reconstruction, what is the company's earnings per share? After reconstruction, what is the company's price earning ratio? Five, evaluate the attitude of the creditors group. This evaluation is to test or to confirm the principle of fairness. You want to check if the reconstruction is fair. Then step 6. You are going to state your conclusion. You are going to tell us in your conclusion if this reconstruction is realistic and achievable. If not, you are going to recommend adjustment So the topic is, it's not the topic you cram. It's a topic that you demonstrate understanding. You can't cram it. All right. We are done with the explanation. Any question? Any question? Clarification?
Yeah, good evening, sir.
Yeah, Zoom
Good evening,
user.
sir. Can you hear me?
I can hear you, sir.
Okay, thank you, sir. Please, this step 5 and 6, I don't know if you can just recap on it. 5 and 6, please. Thank you.
Number 6 is very direct. Tell us your conclusion. Tell us, from your own analysis, do you think the company should be reconstructed? Or should the company be liquidated? So number 6 is very direct. Number 5, evaluate the attitude of the creditors group. Meaning that you are going to evaluate whether the proposal is fair. Is this proposal fair to the shareholders? Yes or no? Is it fair to the debt holder? Yes or no? Is it fair to the bank? Would the bank be willing to accept this proposal? Would the shareholders be willing to accept this proposal? Will the lenders agree to this proposal? You are evaluating their attitude. How would they react to the proposal? Is that clear, sir?
Yes, thank you.
All right. We are done with the explanation. Please go to page 103, question 1. Check your study kits. Page 103, question number 1. What is receivership? Receivership means liquidation. It's a legal term. Explain secure creditors. When we say secure creditors, liability secured on an asset, collateralized loan. If you go to a bank to borrow money, bank now asks you, give us security, give us your assets that we can use as security. In that case, bank is collecting security for your assets. That's secure credit. In the event that you fail to pay, bank will take the assets. So for the other question, receivership. Receivership means it's a legal term. It means a company is liquidated and the asset received. It's also called insolvency. All right. We have an hour to go. Page 103. Let us go to this question together. The latest statement of financial position of Diamond Nigeria Limited is summarized below. Look at below, please. 28.5 million. Inventory and work in progress, 17.5 million. Receivership, 9 million. Current liabilities, unsecured payables. Can you see that? Unsecured payables, 20 million. Bank overdraft unsecured, 8 million. Total current liability, 28 million. Total current asset, 26.5. Liability is more than assets. That's a sign that this business has negative working capital. Our current liability is more than our current assets. That means we don't have money to finance our operation. We have to go and borrow. Next, liability, falling due after more than 1 year. Under it, we have 10% secured debenture. Kenny, look at that question. Secure debentures, that is secure creditors. Secure credits. That debenture is a credit that is given to the company. That debenture is secured. Next, capital reserves. We have call up share capital, 20 million naira. Statement of profit or loss, negative 8 million. That means this company has accumulated losses up to 8 million naira. These losses has reduced share capital. If you look at this statement, all is not well with Diamond Nigeria Limited. Next paragraph. Diamond Nigeria Limited, call of share capital. Call of capital consists of 20 million, 1 naira, ordinary shares, issued and fully paid. Non-current assets comprise freehold property with a book value of 15 million, plant and machinery, book value of 13.5. Debentures are secured on the freehold property. Please asterisk this. Debentures liability are secured on freehold property. This is fees charge, a liability secured on a particular asset. In recent years, the company suffered series of trading losses, which had brought it to the brink of liquidation. The director estimates that in a first sale of the assets, what is first sales? If we are to sell the asset by force, they will realize the following amounts. Freehold property, 10 million. Plant and machinery, 5 million. Inventory, 8.5. Receivable, 8.5. Next paragraph. The cost of liquidation are estimated at 3,850,000. However, trading conditions are now improving, and the director estimates that if new investments in plant and machinery costing 12.5 million were undertaken, the company should be able to generate annual profits before interest of 8,750,000. In order to take advantage of these, the directors have put forward the following proposed reconstruction scheme. 1. All right, if you are trying to manage time, just go and look at requirements. Okay, let me run through this. Freehold properties should be written down by 5 million. Plant 5.5. Inventory 4 million. Receivable 500,000. Ordinary shares written down by 15 million. Debit balance on the statement of profit and loss written off. Secure debentures holder will extend their debentures for 7.5 million ordinary shares and 6.5 million, 14% unsecured loan stock, repayable 5 years time. The bank overdraft should be written off, and the bank should accept 6 million, 14% unsecured loan stock, repayable in 5 years time as compensation. The unsecured payables should be written off by 25%. A right issue of 1-for-1 at par to be made on the shares, on the share capital, after the above adjustment has been made. Lastly, 12.5 million will be invested in new plant and machinery. Requirements A, prepare the statements of financial position of the company after the completion of the reconstruction. We are asked to prepare statement of financial position post reconstruction. That is requirement A. After you have implemented the construction scheme, tell us how the statements will look like. That's what the examiner is asking you. Now the question is, what is the reconstruction scheme? What are the proposals? How would the proposal affect our statement of financial position? That's what the examiner is asking you to do. Let's go to it. All right, wow. I'm tired. Mr. Ibrahim, anything? Wow. Now let's go to this now. But I need to create space. Don't create space, you will enjoy it. So I got to create space here. Otherwise, we might not enjoy the class. If I don't create this space for you, you might not enjoy it. All right. Looking so tiny. All right, let's go to it. If there's need to do more, we do more. But let me expand this so it's looking tiny to here. So you go to the proposal now. Examiner says, give us statement of financial position of this company if the reconstruction after completion, after we have completed the reconstruction scheme, how would the statement look like? All right, sorry for the trouble. We now return here. Now look at it. The directors have put forward the following proposed reconstruction scheme. If we implement this now, how would the statement look like? Look at this. This is the original statement of financial position. This is the company's statement of financial position before reconstruction. Now give us statements after reconstruction. Now ask yourself, what are the reconstruction proposals? One, look at it here. Free written down by 5 million. Now go to the statement. Examiner says freehold property with a book value of 15 million. Examiner says write it down by 5 million. working one. My working one is here. Working one. Non-current assets. Under it, I have freehold property. The book value, that is amount as given in the balance sheet, is 15 million naira. Write it down. When we say write down, reduce it by 5 million. Write down by 5 million. That means I'm left with what? I'm left with 10 million. Freehold property has been written down by 5 million. We are left with 10 million. Next, I have plants. Plants and machinery. Book value is 13.5 million. Value as given in your statement of financial position. Examiner says, write down by 5.5 million. That means I'm left with 8 million. We have reduced plant and machinery by 5.5. Next, working 2. Okay, this space, I require plenty space here. Let me do something down. Okay. I required a lot of space here. If I'm to explain this thing very well to you. Let me spare space here. Yes. Solution.
So please, the plant and machinery, the 13.5. I don't know where you got it from.
What happened to it?
I don't know where you got the 13.5 from.
Where I got was?
The 13.5, the book value.
That's the question with you.
Yes, I have it with me.
Now go to paragraph 3. I'm coming. I don't want to get a space here. I require a space, please. Okay, I can even do the working downstairs. I can do it down here. I'm coming. Have you seen it? That's why when I'm reading, I like when the student follows. I can't manufacture figure. Figure is in the question. Look at it, please. Diamond Nigeria Limited has a call of capital 20 million. The non-current assets comprise freehold property, book value 15 million, plant and machinery, book value 30 million.
Thank you, sir.
3.5.
So please, whenever I'm reading question, every sentence in that question has meaning. You can raise up your hand. Raise down, bring down your hand. All right, we have adjusted that. Now look at the adjustment we are doing. Freehold property should be written down by 5 million. Meaning reduce it by 5 million. You now go and pick the book value. The book value is the amount stated in your financial statement. That property was 15 million. We now write it down by 5 million. We are left with 10 million. Machinery and plants worth 13.5 million. Examiner says write down by 5.5. Next, inventory and work in progress, write down by 4 million. Now go to your statement before. Please note this. This information is for liquidation. All this information, examiner says that the director estimates that in a first sale, this is for liquidation. But we are asked to look at reconstruction first. So your attention will come here. Inventory and work in progress. The book value is 17.5. Examiner says write it down by 4 million. I'll return here. Working to current assets. I have inventory and work in progress. Book value 17,504 million. I'm left with, please, can you bring down your hand? Folusha, we are done with your business. Now, yeah, Toluwani.
Good evening, sir.
Yeah, good evening.
Sir, the plant and machinery. Okay, where is this question? Please help me scroll down. I think there is a place that said investments in new plant and machinery. Can you help me scroll?
We have not gotten to that place now. Are we there now?
Okay.
We started from note number 1. You have jumped to 7.
Oh, I thought we were doing it together. That's why. Okay.
Yeah, I'm doing 1 though. When I get to that place, I will treat it again. That's why less space here. If I jump to 7 now, write down by how much? I'm left with 13,500. We are still on note 1. Yes, at times you can take it together, but students are not the same. If you jump to 7 now, you say, no, now why do you fly to 7? Receivables, write down by 500,000. Our value. Examiner says, write down by 5 million. Let me do this first. I want to place this here, non-current asset. Sorry, current assets. All right, I'll come here. Receivables. The book value. 9 million. Examiner says write down by 500,000. That means I'm left with 8.5 million. We have treated proposal 1. We have treated these. I now go to proposal 2. Examiner says the ordinary shares. Okay, before I go to that, that proposal 1 is what we call asset revaluation. You are revaluing the company's assets. Now, proposal 2. The ordinary shares should be written down by 15 million. And the debit balance on the statement of profit and loss should be written off. Let us treat this. Our ordinary share capital. I'll bring it here. Let me do it here. Working 3. Ordinary share capital. You have quantity. You have price. We have value. The existing shares. 20 million shares. Is in the question. Price per share. Nominal price 1 naira. Total value 20 million. Look at it, okay? Examiner says write down. Write down by 15 million. Meaning that share capital they are worth 20 million. Write it down by 15 million. No, price will not change. That means we are left with 5 million shares. 5 million shares. Number of shares 5 million. Naira amounts 5 million. What has happened here? Existing shareholders has been asked to give up their shares. Give up 15 million of your shares because the company is in financial crisis. We are going to cancel 15 million of your money. Please remember, it's a proposal subject to acceptance. We are only treating the proposal first. It does not mean shareholder we accept this. Look at it here. Let me show you the note again. Where is that? Look at it. Diamond Nigeria Limited. Call-up capital consists of 20 million. 1 naira ordinary shares. Examiner says, write this 20 million down by 15 million. Again, look at it. The debit balance on the statement of profit and loss. Examiner says, write it off. This 8 million loss. Examiner says, write the 8 million loss off. Cancel the loss. So when you get to your new statement, you are going to disregard this statement of profit and loss. We have treated proposal 2. Look at proposal 3. The secured debentures holder would exchange their debentures for 7.5 million ordinary shares and 6.5 million 14% unsecured loan stock, repayable 5 years time. Let's explain this. Debentures is a debt. Now, the debt is being converted to equity shares and to another type of debt. A secured debt is being converted to ordinary shares. They are worth 7.5 million. Debentures, secured debentures was 15 million naira. Go and check your statements. Look at it here. Debentures holder has given this company a loan. They are worth 15 million naira. This company cannot pay back the loan because the company is experiencing financial difficulties. Now, the company now proposed a reconstruction that please, debentures holder, let us convert your money to equity shares of 7.5 million and unsecured loan stock of 6.5. We are going to repay you this loan stock in 5 years' time. Let us treat this now. I'll trade this. I'll come here. Under ordinary shares, this is the original shareholder. Original shareholder. We now have debentures. Debentures converted to debentures converted to equity. 7.5. Naira price will not change. That is the nominal price per share. Amount 7.5 million. What this means is that the debentures holder is now part of shareholders in the company. If the company is reconstructed, working for 14% unsecured loan stock, repayable 5 years. Debentures will be converted partly to equity, partly to unsecured loan stock. Debenture to collect 14% unsecured loan stock, they are worth 6.5 million. Assuming 30. If the debentures holder should accept this, they will lose 1 million naira immediately. Because if you look at it, 7.5 plus 6.5, that is 14. The debentures holder has given a loan of 15 million. Again, always remember, what we are doing here is the proposal. We are trying to look at if the proposal is implemented, how the statement of financial position will look like. It does not mean the debentures holder will accept it. Look at proposal Proposal 4. If you have the question, open on your system. Proposal 4. The bank overdraft should be written off. And bank should receive 6 million 14% unsecured loan stock, repayable in 5 years' time as compensation. If you have that question open on your system, bank has given overdraft of 8 million naira to this company. This company cannot pay back. That's said, no, please. That's a bank, please. Let us write off the 8 million. We now give you 6 million naira worth of unsecured loan stock. We are going to repay you this money in 5 years' time at an interest of 14%. I'll come here. Under 14% unsecured loan stock, you put bank overdraft. Now converted to 6 million naira worth of unsecured loan stock. If you interpret this out, overdraft is a short-term loan to be repaid on short term. But this company now says, let us cancel overdraft. Let me give you unsecured loan stock, and I will pay you back in 5 years. That is deferral of debt repayment. You are putting repayment to 5 years' time. You are trying to give your business some time to operate business and make more money. This is the venture. This becomes 12.5. Please open the question on your system. To reduce my strain up and down, I have it here also. Look at note number 5. Unsecured payables should be written down by 25%. Working fine. Working fine. Unsecured payables. What is the book value? The book value is 20 million. Value as shown in your statement of financial position. 20 million. Write down by 25%. Compute 25% of 20 million. That will give you 5 million. Balance 15 million. Note number 6. A rights issue of 1-for-1 at par to be made on the share capital after the above adjustments have been made. Look at note number 6. Examiner says rights issue 1-for-1 at par. What is rights issue? Issuing new shares to existing shareholders. The examiner says after the above adjustment has been made. Now after the adjustment, we have 5,000 shares here plus 7,500, totaling 12,500. Naira amount 12,500. Now we now do rights issue. Rights issue 1-for-1. If you interpret this out, 1-for-1, for every 1 share in existence, issue 1 new share, additional new share. So if I have 12.5 million shares in existence, I have 12,500 shares in existence, and I'm doing 1-for-1. I'm going to issue additional 12,500 shares at par. The par is 1 naira. They allow me to take this off to avoid confusion. The par value is 1 naira. Amount here 12.5. Total year 25,000 shares. Naira amount 25,000. Last note, 12.5 million to be invested in new plant and machinery. That was what Tolua was asking. That will affect your plant and machinery value. I'll come here. Plant and machinery. New investments. New investments in plants. 12,500,000. Total plant now 20,500,000. You are done with all the adjustments. You can now do your statement of financial position. Under non-current asset, free of property, check working 1. Amount is now 10 million, 10,000. Week off, yes.
Okay, sir, please
Plant and
explain.
machinery.
Okay, sir, please explain the last one, the 1-for-1 rights issue.
Okay, second to the last, not the last one.
Okay, yes, second to the last.
Our examiner says a right issue of 1-for-1. The first question is, what is right issue? Issuing new shares to existing shareholders. The example now says 1-for-1. If I have 1 share before, issue additional 1 shares as rights. When I say 1-for-1, it means for every existing shares, issue 1 new share as addition. So if you have 12,500 shares, how many new shares will you issue as additional?
12,500.
That was all we did. Inventory
Okay,
work in
thank you.
progress. Look at the adjustments. We are left with 13,500. Receivables, we are left with 85. Total 22,000. That's our current. This is total non-current assets. Total current assets. Current liabilities. We only have unsecured payables. After adjustments, the balance is 15,000. Difference. Current asset minus current liability. That gives you your working capital. 7,000 is here. 22 minus 50. Then you have total non-current assets. 30.5 plus 7. That will give me 37,500. That is total assets less total liability. Next, liability falling due after 1 year. We have unsecured payables. Sorry, 14% unsecured loan stock, repayable 5 years time. Amount is 12,500. The difference. That's 7,500 minus 12,500. That will give us net assets. Net assets 25 million. Your net assets, total assets minus total liability. Capital reserves. The capital reserves, the share capital, 25,000. Your balance sheet balance now. We only pick what I did, or what we did. We only pick all the adjustments. Freehold property, 10 million. Plant and machinery, 20.5 million. Inventory work in progress, 13.5. Receivables, 8.5. Share capital, 25. Unsecured payables, 15. Unsecured loan stock, 12.5. We only pick all the adjusted balances to produce our post-reconstruction statement of financial position. That statement shows if the reconstruction is implemented, how the statement will look like. The statement of financial position. Wow. We are done with the A part. We have only treated part A of the question. Look at it. We still have part B. Look at the part B. Prepare reports, including appropriate calculations, discussing the advantages and disadvantages of the proposed reconstruction from the viewpoint of the ordinary shareholders, secured debentures holder, and bank. We shall stop here. Yes, Felicia.
Thank you, sir. Sir, please, for the total assets less current liability, sir, are we not supposed to less it, which will be getting 27,500?
I didn't get that.
For the total assets less current liability for our reconstruction, did you add it or you less it? Because it looks like we added.
And I'm supposed to add it now.
But here it was less in the question. Yes, now they deducted it now.
If you look at this statement where we already less this current liability is in brackets here. 22 minus 15. Current assets
Okay,
minus current liability gave you a working capital. This is called net current assets. You have removed the current liability already. This balance now is called net current assets. Add it back here now. Or you can also do like this. Non-current assets plus current assets minus current liability. Is that better, Felicia?
Yes, sir, I understand it that way, adding my current, non-current and my current together, then deduct my current liability.
That's what they did here also. Look at this statement they give us. Non-current assets. Then we have current assets. Current assets minus current liability. That gave us negative. Because this is negative,
Okay, sir.
28,500 plus negative 15. You are still going to have 27 here. Is it better, Felicia?
Yes, sir, it's better. Thank you, sir.
Toluwani, 6 marks for all these calculations. Okay. You want to copy, no problem. So we are going to stop here share tonight. When we meet next week, although you can copy, but we are still going to share it. When we meet next week, by God's grace, we should complete this question. We should even complete the topic. If you want to copy Mr. Promise, this is the share capital.
No, sir, to the extracted, reconstructed statement of financial position.
I don't understand you, Promise.
Yes, sir, to the post-reconstruction statement that we just finished now.
Okay, the statement itself.
Yes, sir.
That is page 1.
Exactly. Yes, this.
Is it fine? All right, may God give us a better understanding.
Amen.
The mark is not the major thing. The major thing is that you understand this. Once you understand it, like I said, ordinarily in the exam, you are going to look at requirements first. So as you are reading, you are solving. Because the question, if you want to read first 10 minutes, go to requirements, go and look at requirements. So as I'm reading it, I'm solving it also. Let's have a good night.